Joining me now is Doug Silver. He's the CEO of Balfour Holdings and also the author of Rise of the Royalty Companies. Good to see you, sir.
Good morning.
Now, you write in the book that the royalty streaming model really started in the mid-'80s with Franco-Nevada, Seymour Schulich, Pierre Lassonde, and now you've got about more than 35 of them, combined market cap of something like $65 billion. So give us let me ask you why you wrote the book, first off.
Yeah, the book was an inspiration. I built International Royalty, which was one of the larger royalty companies that I sold to Royal Gold. And what it dawned on me is that all the founders of the largest royalty companies are now retired, but they're still alive. And so I thought it was really important, because the royalty industry is relatively young, that we capture their stories. So I asked each one to limit themselves to 10 pages, which was a negotiation in itself. But, like, what were you thinking at the time? What were the markets doing? Why did you think it was a good idea? Tell me some good stories, some bad stories. And I managed to get 11 of the largest companies to write their stories.
Including Lassonde and Schulich, I'm assuming?
Yes.
Right.
Yeah.
And so based on what they wrote and based on what you know about them and your research, what is it about Lassonde and Schulich that make them and made them so successful?
Well, you have to read the book. No, they... Pierre and Seymour are both entrepreneurs. Pierre has a mining background, and he saw this opportunity. And because Seymour is an oil guy, Seymour knew all about oil royalties. And apparently they had a discussion, say, how come we don't have mineral royalties like we have oil royalty companies? So that was the relationship that served as the catapult for Pierre, creating the mineral royalty industry.
So a light bulb went off for both of them, it sounds like.
Yeah, they saw the opportunity.
All right, so we've seen all this growth over the years since the mid-'80s to now. So how would you say the sector has evolved?
The sector's evolved tremendously because of the size of the companies. I mean, hypothetically, investors want to see you grow your revenues 10% a year. But when your revenues are $500 million a year, there's no royalties that you can buy that generate $50 million a year. So what happened in 2004 is the streaming model, which was originally, Wheaton had the streaming model as a synthetic silver company. They actually considered themselves a synthetic mining company. Streaming became the path to go. And if you look at today where the money is going investing, it's in streams, because most of the big royalties are now owned by one of the big royalty companies. I mean, we've had 37 years to find them, snarf them all up, and it's pretty much done at this point.
And we've talked to Paul Brink, for example, the CEO of Franco-Nevada now, and others. So what would you say are the key attributes of these royalty and streaming companies that make them so successful and in good cycles and bad, and it's a very appealing model? Yeah,
I mean, there's two aspects of royalty companies which make them the best mining investment. The first is you make the initial investment, even with a stream, you make the initial investment, but there's no future capital calls on you for that project. So if they find more ore, you get the benefit. If they expand the mine, you get the benefit, but you don't have to put the capital up. And the other, it's an exceptionally scalable business. So if you buy a royalty or create a stream, it's basically coupon clipping by your accounting department. So you can have very small staffs and you can have huge revenues. And in the book, I actually compare the revenues per employee of the big royalty companies versus Amazon and any of the other big companies. And it's orders and orders of magnitude bigger. So the money is going to the bottom line almost immediately. And it's just a better way to play metal prices.
That's fascinating. Now, we're going to be talking to Rob McEwen shortly, and he made a comment recently, and it maybe you might find it extreme, but he thinks that a lot of these royalty companies, they dangle money at juniors. The juniors are desperate for the money. They say, yes, please, we'll take it. But in the process of doing that, they often hinder their profits, and McEwen used the word their profits are being stolen to a degree. So are there drawbacks to the model for juniors?
I would answer that a little differently. Not everybody's as desperate as McEwen. No, I like Rob a lot. So here's the thing. If you do a financing, it's dilutionary, an equity financing. It's dilutionary for the history of your company, unless you do buybacks, of course. And in this case, you're letting somebody buy a piece of your future action. So yeah, it's going to lower it, but the royalty is tied to the performance of the mine. So it's not tied to the company's equity position or anything else. So it's a trade-off. You want to do an equity dilution forever, or do you want to sell a very small piece of your mine? And in the case of streams, it used to traditionally be the byproducts, which is not what the focus of the mine was anyway. It's a way to do financing. If you take debt from a big bank, they're taking a big piece of your profits too. So the idea that somehow the royalty companies are singularly hurting, the investors, that's just not fair, because you're getting paid back over the life of the mine, not in 2 years when your debt is due, or diluting yourself instantly forever.
Right.
So I don't think it's fair. The other thing too that's wrong with your statement, nothing personal.
Rob's statement.
Another thing is that most of the royalty companies don't do deals with juniors. Investors want to see near-term cash flow. So if you look at the focus of the big and the intermediate-sized companies, they're all looking for something that's going to be in production in a couple of years. So if you have a portfolio of grassroots projects, it's going to be very difficult to finance it with a royalty, because it may be never. So they tend to move up the food chain, and they're looking for stuff that has preliminary engineering or better.
Lastly, Doug, investors always like ideas. You may have a couple for us. You sit on the boards of a couple of royalty companies,
Right.
Nova and Metalla.
Metalla.
Okay, what can you tell us just briefly about both those two?
Well, they're sister companies. Nova is the base metal spin out of Metalla, which was the precious metals. So one is I went to school at the University of Arizona, so I'm a copper guy. And when I built International Royalty, our biggest royalty was on the Voisey's Bay nickel mine, and I was buying copper royalty. So I love copper and nickel. I have a history of that. But most of the royalty companies are precious metal focused. So if you want to continue to play in this space, you should also have a presence in a precious metal royalty company. And Brett Heath, who's the CEO of Metalla, he made me a very nice offer where I got to play with two royalty companies at the same time, and that was just too tempting.
Very good. And they're obviously both public.
Yeah.
Okay.
Yeah.
Excellent. Well, we really appreciate it today, and good luck with the book.
Well, thank you very much.
Okay. Doug Silver, author of Rise of the Royalty Companies.